Hello and welcome to another episode of Fireside Chicago, where we host fireside chats with prominent leaders from Chicago's business community, live on Zoom with interactive Q&A. I am your host, Tim Shum. I'm also the founder and president of Lucas James Talent Partners, hourly recruiting firm here in Chicago. We have a very interesting, awesome guest list for August that you can see in front of my screen if you're here with us live. Today we have Kenny Estes. We're going to get into Kenny's conversation, Kenny's background here in a second. Last week we had Ed Scanlon on the show. This Thursday we have Elliot Garms, co-founder and CEO of Human Predictions. We have Abalorde Eshigbe, co-founder and CEO of 4 Degrees. Bobby Achedu, co-founder, CEO of Accelerated Growth Advisors, later in the month. And then we have a panel, Diversity, Equity, Inclusion in the Workplace. Jaya Brown, Lauren Henley, and Corey Haynes are going to be joining us. Super excited for those shows. Make sure you check those out. Follow us on LinkedIn if you aren't already, and then you can find us anywhere that you get podcasts as well. Today, I'm really looking forward to chatting with Mr. Kenny Estes. There we go. Kenny is the general partner and co-founder of West Loop Ventures. He's the current co-founder and CEO of Diffuse. I'm really looking forward to unpacking Kenny's background a little bit. I've known Kenny over the last, maybe 3 or 4 years. Former prop trader, high frequency trader, early employee, built a trading firm that exited at hundreds and hundreds of employees, moved across the overseas to the UK, started a venture capital firm, started his own real estate investment firm. We have a lot to uncover and unpack here with Kenny Estes. But Kenny, I know you're a busy guy. You're traveling across the country here later on today to close on a house in Chicago. So congratulations, but thank you so much for carving out the time for us today.
Thanks for having me. Really appreciate it. Nice to, the presentation's gone. And I'll do this because the branding 101, right? Here you go. There's the name. Put the background on there for you. No, it's great to have you. And yeah, we're excited to be back in Chicago. We had effectively a prolonged pandemic summer out in the middle of nowhere. So.
Absolutely. Yeah. Maybe for the folks, I mean, COVID hit and, I've talked to you a few different times, but where did you go? I mean, it looks like you got out of Chicago for a little bit and you're going to be gracing us with your presence here again.
Yeah, COVID hit. I'm like, this vaccine is not going to be here for 12 months. So we actually sold our house and moved to a farm in the middle of nowhere, South Carolina. Pool and I think it was like 2,000 acres. It was like great, just kids run around, didn't see a soul, kind of social distancing, all that stuff. But we might have been a little premature in getting another house under contract up in Barrington.
And now we're pulling you right back into Chicago for sure. Yeah, I would say that's probably social distancing at its finest. If you can't see anybody, if you're walking a mile, I think you're in a good spot for sure. I think you're safe. Well, yeah, thanks again for joining us. Let's just kind of just for the audience. I know you, we've known each other, but let's just start with your background. We can get into a lot of different things, but let's start in high school because I think that's where maybe your professional career kind of all started. So take us from there, and then I'll kind of poke you with a few questions as we go.
Sure. Yeah. So, I went to high school, and then I honestly don't know why, but my brother's friend was doing like a summer job at this firm in Chicago, a trading firm. And I didn't know anything about it or anything about that world. So for whatever reason, I became a little bit fascinated with it, and made sure I got my CV over there. I ended up getting I think I was the one and only summer intern there. The other guy was more full-time at that point. And so I started working there, and then I just worked while I was going to college. We can talk about that if you want, but every break. So spring break, Christmas break, summer, the entire thing, just any opportunity I could have to work down there, because the reality of trading firms is people want to take breaks during holidays because nobody's trading and you have to have volume to make money. So me stepping in was good. So that was great. It always had something to do, really focused on kind of coding, quantitative modeling, all of those things. And then I was at that firm for about 10 years. So when I first started off as the intern, again, I was really watching people's models and picking it up from osmosis. I was affectionately known as the piss boy, because that was the guy that you would call when you had to go take a piss, so that I could watch your models and make sure nothing went terribly awry. But I did 10 years there, 6 years, and I was maybe their 15th employee. So 6 years in Chicago, 4 years I helped spin up their London operation, ran the European cash equities desk. And I left just before we completed a merger that would have made it a 1,500 person, $2 billion market cap public company. So it was a very interesting experience. Along the way, I started spinning up investment funds. So mostly real estate. We bought a ton of real estate via these fund vehicles, 09 to 11. So that's the right time. I mean, we kind of picked the bottom at more of a fluke than anything, I think. And then I just continued on that path. So spinning up more investment vehicles. The most recent one I've started is Westloop Ventures, which is a fund that exclusively does early stage business to business financial services startups. So that fund has maybe one new company we'll invest in. It's on the tail end of its deployment cycle. So if you know anybody who has a startup whose customer is a bank, insurance company, asset manager, hedge funds, like that's the stuff we like to play with, or I like to play with. So shoot them our way. We might be an investor.
That sounds good. That sounds good. Always do. Just unpacking this a little bit more. So one, that's crazy. All right. So you're an intern, employee number, what, 10, 12, 15, somewhere along
I say
those
15.
lines.
I actually don't know the number. It's around there.
So it's 15, eventually grows over a 10-year period, which is essentially a pretty short period of time to grow from 15 to, 1,500 employees globally. Walk us through that a little bit more. What was that experience like? I think a lot of us, what shapes us today is our experiences from the past. What did you learn there? Were there mentors along the way? Maybe what are some big wins that you had in your career before exiting that business and, doing what you're doing today?
Interesting. Yeah. I've never been really prone to mentors for whatever reason, but there were a lot of people that I definitely respected there. They were always the Silicon Valley mindset was prevalent there. Right? They got the ping pong tables and biz cash. I wore a hoodie and jeans every day to work. And it was very much the meritocracy of, hey, it doesn't really matter who's senior, which is why I could do what I did when I was 18, right? It's more what the value of the idea is and who can really prove the point. And then the other one that is actually kind of a funny story is we really early tried to not be reliant on anybody else, right? If it's something that we could do in-house with our technical expertise, we did it, even though it wasn't necessarily a core competency. So not to bore you too terribly much, but we were what's called self-clearing. So we didn't have, at least for our equities trading, we didn't have a third-party clearing company that we had to ride on their rails to trade. Likewise, we did all of the direct connectivity. There was no intermediaries. We owned the technology. And it was good technology because we hired good engineers. So in 07, 08, when the world started to fall apart, that was incredibly valuable because so many people were dependent upon legacy systems, which were just not capable of handling the sheer amount of volume throwing through the system. So a lot of days, the big drop days, people were not in the market. There were days in 08, in the most lucrative time for that style of trading, where I personally was 5% of all US equity volume. So if you wanted to trade any stock on those days, it was a 1-in-20 shot, you just trade with me. So it was just unbelievable good fortune to have all of that stuff out the gate. So I don't know, there's an interesting life lesson there as far as like self-sufficiency. I don't know how entirely extensible it is though.
Sure. Well, so, I mean, we're going through a crazy pandemic that's leading to this, sharp recession, stock market, at least, initially was super volatile. There was a lot of uncertainty in the market. People were getting in, getting out, getting in and getting out. When you went through 07, 08, 09 with what you were doing as a trader of US equities, what did you learn from that experience that might present maybe some opportunities now, if you're still doing the same thing, or maybe even just like an individual investor?
Yeah, that's a good question. That style of trading is not extensible to individuals at all. You have to have a lot of infrastructure for that to work properly. As far as current environment, I don't get what's going on, to be honest with you, right? I think that the stock market is look, I get the argument that the stock market is really long-term discounted cash flows, and this blip for the next 3 to 6 months is going to go away, and then we're going to go back to normal. I'm not entirely sure that it's going to be quite as quick of a recovery, and I don't understand why we're near our all-time highs. I just, you can't have GDP off 30% and still be here. It's a little bit strange, and I think it has more to do with people being a bit bored, to be honest, and throwing money into the stock market because, I don't know, the casinos are closed, right? Like, feels a bit like that.
Right.
But there are still pockets of opportunity. When there's so much uncertainty, you're always going to be able to find asset classes or approaches that are, if you really look for those opportunities, you can do it. Like for example, one is, just came across my desk yesterday, and it's just a silly one. You can, because margin rates are so low, like Morgan Stanley is offering this product where if you're just buying passive index funds, right, they will sell you a product to lock in for 7 years alone against your securities product at 2.6%, right? A lock in 2.6 on 7, so you get all of the equity upside, and the interest rate on that is just, unbelievably low, and I can almost guarantee it's gonna be way higher than that by the time this thing matures, right? So those types of opportunities with these weird interest rates we're seeing, the equities being where they are, those dislocations are very much exploitable.
Would you be shocked, as close to it, regardless, I understand that you were a high frequency trader, everything was based on algorithms, you're getting in, you're getting out a billion times a day, but it's just in terms of the volatility and, some of the curveballs that kind of get thrown with government intervention or, just people's emotions kind of going one way versus the other. Would you be shocked if there was a sharp pullback from here? Or do you think, maybe another round of stimulus will kind of keep everyone back at the casinos again?
I would not be in any way, shape, or form shocked by a pullback here. I'm pretty heavy cash at the moment, quite deliberately, because, I don't know that I want to go super heavy in equities right this second.
Fair enough. Well, let's continue on the story. So you have this experience that, not a lot of people, start as a 15th employee and then leave as employee 1500. You have other things you want to do. Clearly, you're doing them now. When you left that organization that you spent 10 years at, what was going through your head? What ideas did you want to start doing? What was going on in your life? What led you to essentially what you're doing right now?
Yeah, this is going to be a not the best answer. So when I left, I didn't think I was ever going to go back to work. I left because the guy that I was reporting to was the former number 2 guy at UBS. He didn't get the CEO job, so he came over and he just wiped out the whole company's leadership and replaced it with UBS O'Connor guys. So I'm like, that's not really where I want to work. So I had ambitions of maybe kind of continuing on my real estate funds, but more or less I kind of took a few years off. But then I realized that I'm just not geared that way. That's very, very, very boring. Even if it's physically, if it's capable, if you're able to do that, it doesn't really gear. So that was around the time I started up Westlake Ventures, same time that I started actually going to University of Chicago booth, which I think some of the people actually I met over there on this call. It was more putting irons on fire and on the fire and seeing what came out of it. The Westlake Ventures is good, going great, but then I launched a platform called Diffuse, and I realized as part of this, hey, what do I want to do when I grow up conversation, that I'm not so much a serial entrepreneur as a serial boutique fund. So what we're doing with Diffuse is we're taking folks that want to be VCs, but don't necessarily know what that looks like or how to get into it. And we run them through a step-by-step process to get them to their fund launch. What's your thesis? What's your background? How are you going to tell the story? How are you going to approach investors? How are you going to screen investment opportunities? And then when they're launched, we will actually run their fund for them. So we'll run your deal pipeline. We'll give you all the checklists, the deal memos, the valuations, all of those pieces, so that you'll have a rigorous process that will appeal to your investors. And then we'll take, a chunk of the management fee, a chunk of the carry, but you are freed from all of that heavy lifting and can focus on the fun bit, which is helping entrepreneurs build companies. And if we do our job well, and as we're doing our job, in the extreme, you can run a VC fund while keeping a full-time job.
Interesting. So we've talked about this, but I think for the audience, when I think of a venture capitalist, if anybody has seen the HBO documentary, it's on HBO. I don't think it might have been produced by HBO. It's called Something Ventured. It's about the venture capital industry, starting with the semiconductor industry back in like the 60s in San Francisco. And it didn't really exist back in the day. And then, VCs were essentially like a couple firms coupled with really, really wealthy angel investors. And then you fast forward, I'm missing a lot of steps, but you fast forward till today, there's a lot of venture capital firms. There's a lot of micro VCs. There's a lot of opportunity out there. And I think a lot of other individuals are looking at the asset class, but a lot of former entrepreneurs that maybe had an exit with some money in the bank, or investors, meaning that they worked for one of these venture capital firms and then like spun off and started their own because they knew how to do it. Well, what's your view, I guess, for myself and the audience, of like the current VC landscape? And I think your value proposition makes a ton of sense, but why this is a pain point for some of these VCs that are spinning up?
Yeah, in terms of legacy VC funds, you're right. Like, it's a bunch of folks that it was very easy to make money when nobody else was playing in this space. But there is just a ton of competition now. There's a ton of these small VCs all over the place. And for better or worse, they're still trying to apply the same model that existed, 20, 30 years ago. They're all generalists. It's all about the underwriting and the TAM and all of these things. But the entrepreneurs are starting to realize that, well, actually, the value add of the VC is a lot more important. So you say, those serial entrepreneurs who have an inkling towards starting a VC fund, historically, they'd be kind of stuck, right? Unless they were really, really big, because they don't have the operating experience, the underwriting. They go to LPs, they don't get very far. But that's exactly the type of people that add the most value to the startups. So that's the biggest source of our pipeline, is folks that are serial entrepreneurs, and we'll just run the fund and allow them to work with the entrepreneurs. Plus, micro VCs is typically defined as a venture capital fund that has less than, say, 50 to 100 million in assets under management. You have seen just a huge uptick in the number of those tiny funds over the last 10 years. And I think people realize that maybe that the VC walled garden, that wall isn't as high as you think it is. There's not so much secret sauce once you kind of really understand what's going on, and people are going after that mode. And that's part of what Diffuse is trying to do, is tap the people that do add a lot of value, tear down that wall, and allow this platform to bring some rigor, some process, some institutional grade infrastructure for these VCs.
So you mentioned there's not, for lack of a better term, like barrier to entry in the industry, like maybe people perceive that it would. Maybe in its simplest term, if I want to go start a venture capital firm and I have the ability to go raise funds from investors and then go find entrepreneurs, then it's just a matter of compliance, administrative, technology, structure, all that kind of stuff. Is that the most simplest way to put it?
Yeah, that's a good way to say it. I've also sometimes explained it like, if you want to be a good VC, right, what do you need to do? You need to raise money. You need to source deals. You need to work with the entrepreneurs. And then you need to do the operations of the fund. The historical VC model is you're going to find, especially micro VC, like micro VCs is typically a 1 or a 2 person shop that they've got 10 to 20 million AUM. So you're going to have 2 people. The economics can't support a bigger team. And now they have to do all 4 of those things well. That's kind of a silly value prop. Like that's a silly argument to make, that you're going to have 2 people that can do 4 things well. So what the new model that we're trying to bring in is specialization, right? We'll do the administration, just bring in the folks who are really good at working with entrepreneurs and sourcing deals. We'll bring in capital sources because they're going to be used to our system, our process, and really just streamline the whole thing.
Do you have any, I'm sure you do, but what's your insight or view on just the VC industry in general, say over the last 5 to 10 years? What's the increase there? What's the the number of dollars that are associated with this asset class versus other asset classes from before. I mean, there's got to be a huge trend. I'm just seeing it in Chicago of VCs springing up all over the place, and I can see this being a huge pain point for them.
It is historically the highest yielding asset class, far enough. And I think, like you said, 20, 30 years ago when this was a new industry, it wasn't really proven out that that was a sustainable return, but now we're seeing it. Actually, it kind of is. So you are just seeing a ton of capital flowing in. The issue is that I think we've especially up market, with the soft banks of the world, you're seeing just too damn much money chasing these deals, and you're getting these crazy valuations. It's not entirely sure if these things will ever be profitable or like what the underlying business plan really is for long-term viability. But I still think that in that smaller down market area, huge amounts of opportunity, like unbelievable amount, because the people that are writing the big checks, like they can't write a $200,000 seed check. It is not worth them waking up to do that effort. So it's a lot of untapped opportunity, which is why you're seeing so many more of these small boutique type funds going after different angles down the market.
Could you explain the different types of venture capital firms and then how they operate at different stages? Because I think you're right. Like even here locally, GoHealth went public, but if quick Google search will show that they did they did a deal prior to that from private investors, and then another deal prior to that, private investors. They very well could have taken it, straight to IPO. They decided not to, but that there's investors at that later stage that make a ton of sense for different reasons than I'm an early stage entrepreneur looking for my first check. What does that landscape look like? And then for Diffuse, where are you specifically trying to play, and what's your sweet spot going to be?
Yeah, the later stage is, it's effectively an oligopoly. There's not that many players. Actually, one of our portfolio companies just did this exercise. It's about 20 folks that will write those really big checks and have a huge ecosystem and an established brand. And it's, the Andreessen Horowitzes and the NEAs of the world. And everybody wants to go be one of their portfolio companies because they're so damn big, right? And like once you're in that ecosystem, it's a very nice place to be. That honestly, it's very difficult to crack into, and it's a 10 to 20 year horizon before you're able to. For us, we're not of any interest. We want to go down market. We want to figure out a way to deploy capital efficiently where nobody else can, and that's what we're trying to do. It's also, by the way, because it's so hard to get capital efficiently deployed down there, it's by far the highest returning area of venture capital. Every round. And it's even on a risk-adjusted basis, your seed, your risk-adjusted return on average is higher than Series A, is higher than Series B, is higher than Series C. Every additional round, your return as an investor goes down. And that's directly a function of bigger checks, less price sensitivity, more and more players. You can kind of do that until you get to the extremes of the soft banks of the world where, oh, we're going to write you a $2 billion check, but the valuation is not overly important.
Very interesting. Now, myself, our firm, we do a lot of work with typically like Series A, Series B companies, even seed companies that get some capital. We kind of come in and take care of the hiring for them on an hourly basis. Mm-hmm. We did a lot of work in 2018. We did a lot of work in 2019. We did a lot of work in Q1 2020, and things kind of slowed down a little bit from that deal cycle, of course. What do you see from your lens and being a VC yourself about maybe the next 6 months in 2020 and what 2021 will look like in terms of maybe deal flow or, money coming into this asset class?
Yeah. So you see a lot of companies that have been delaying going to market. COVID hit, and maybe I don't want to go do a big down round right now because the down round is where your valuation for the current fundraising round is lower than your previous valuation. That's almost the kiss of death for startups because the startup game is it's an escalator, right? Another round, up we go, up we go, up we go. Going backwards, it doesn't look very good. So a lot of companies have been delaying going to market. They're cash situation is getting more precarious by the day. And I think come Q4, they're not going to have an option anymore. And you're going to see a lot of opportunities at bargain rates because so many of these people are now desperate to get some financing. Otherwise, the company's going to fold.
Interesting. And then, if you're a VC that's already in one of these companies, how are you advising that entrepreneur? Are you putting in more money yourself, to maybe avoid that kind of go-to-market situation where the market rate would dictate what valuation you get? Are you letting them fend for themselves a little bit? Or are you saying like, hey, let's get some outside cash into the company right now?
We did a bit of both. We were pretty lucky in our portfolio and that not many of them were super negatively affected. I think only one of them we had to kind of do a top-up injection of capital. There is also a type of VC investment strategy. It depends on who you talk to. It's called royalty-based financing or maybe revenue-based investing. And the idea there is they invest and they take a flat percentage of your revenue until they get some multiple of their capital back. And then they take some warrant coverage on top. So that is a very appealing way of getting financing in the current environment, because you can get the money in. Your repayment is exactly tied to when your business comes back. So if your revenue is zero, you're not paying anything until your business comes back. So it's very entrepreneur friendly. It's non-dilutive, and it doesn't force a valuation. So you can raise royalty or revenue-based financing today, and it's not a down round because it's a completely different structure and it's kind of apples to orange comparison.
That's super interesting. This might be like tapping into the VC playbook a little bit, and feel free to not share if you don't want to, but I got to imagine when you model this out using Excel, there's a reason why that's going to be super attractive, right? So obviously what's in it for the entrepreneur? I don't have a down round, right? Mm-hmm. I get to save face a little bit. I have a variable, way to raise some cash. I can continue with my business operations as planned, as I've pivoted around COVID. But for the VC, that's got to be advantageous. I think there's a liquidity element, like I'm getting cash maybe quicker than down the road. But how do you see that, and what can you share as it relates to that strategy?
Yeah, and actually Diffuse, one of the funds we're incubating, well, actually two of the funds we're incubating are doing this, so I'm very much biased. But as a VC, like it's great because it's the standard mantra is 7 to 10 years hold period, and you're not going to see a dividend until you liquidate. This is not that. This is we're going to be out in 2 to 3 years. We're going to be getting regular payments. They're going to be variable payments, but they're going to be relatively regular. It's very appealing. And with the warrants, you still have some of the upside. And they all the capital restrictions are actually a lot less because there's no preferred return. Well, they're debt, right? So I guess you're senior to everybody else. And you don't take board seats in that scenario. It's not the traditional, we're going to micromanage everything that you're doing. It's automated. It's a little bit fly by wire. So it is a bit different. It's closer to debt than equity. It's somewhere in between. It takes a certain type of investors know what they know. And actually, I was having this conversation with one of the funds we're working with this morning. If you're a debt investor, you want to invest in a debt-looking thing, which is making debt investments. If you're an equity investor, you want to invest in an equity-looking things, making equity investments. So as an example, if you're a debt investor, I'm going to get my 12% return, so a hurdle, and then I'm going to get some share of the upside above and beyond that. That's how you invest. And then when you turn around and that you put that in a fund, and then they turn around and invest in their portfolio companies, you're going to understand it best if it's structured as a debt investment. Equity is, I'm going to put money in you. I'm going to be junior to everybody else, but I'm going to take a flat percentage of your company and the upside, completely different structure. Even the funds, one's got the pref and the hurdle, one's got a management fee and carry. And it's really interesting because I think a lot of the opportunity is going to be somewhere in between. But you just don't have a massive investor base that understands enough about both to create a synthesis of it.
Interesting. What's I've always known you to be a guy that thinks outside the box, alternative ways of doing things. In fact, I think the company that we worked together on was doing more of like an initial coin offering, using cryptocurrency to raise some funds. But what are some other alternative options for venture capital firms and then subsequently entrepreneurs to raise capital that might be outside of the traditional go to market, give a piece of equity, go to market, give a piece of equity, hopefully exit one day?
Yeah, I mean, the royalty-based financing is good. You have to have revenue for that to happen. I think you're always going to have that friends and family straight equity round. It's no way around get around it. I think ICOs are dead, rightly so. I mean, I was involved in selling part of a STO, I guess it was, and it was just, I was astounded by how price and terms insensitive the investors were. I'll say it like that. So I don't think that's going to come back anytime soon. A lot of people got really burned there. But yeah, outside of that, I mean, it really is, it's either debt or equity or somewhere in between. I don't think you can get super, super, super creative there.
I want to talk about Westloop a little bit, Westloop Ventures. This is kind of where we met. You had mentioned that you try to make investments only within the financial services fintech space. To me, I think, you really, really, really have to understand that space like yourself, how money moves around, how all the different players interact with one another, and then maybe have some sort of thesis around what the trend is moving forward. But, what are some examples of interesting opportunities in the fintech space, either within the Westloop portfolio, outside of the Westloop portfolio, but what's happening in the fintech space that, made that focus most appealing for you?
Yeah, sure. Is he still on? Yeah, Adrian's on, so he'll like this one. So insurance is an area of particular interest, and it's one of the most backwards industries. Like there's so much inertia to overcome that, and so much bureaucracy, it's very difficult to do. And the capital sources are tied to these big behemoth firms that rightly can't do quick changes. So one of the companies we're invested in is called Cover, and what they do, it's actually kind of got a blockchain element to it, but it's not the key piece. They allow for rapid prototyping in insurance. So you have a new idea for a new insurance product that doesn't have good data, isn't really underwritable. Carriers today can't launch that product because they've got a list 200 long, and the amount of compliance and actuarial and like work it takes to get this policy and this product off the ground is enormous, and it's very difficult to prove that out. So what these folks do is they say, okay, we're going to do a self-insurance pool, and we're going to take a best guess at what the premium is, and we are going to have people pre-fund the premium, kind of like Kickstarter, where once we get 2 million, 3 million, 4 million in this self-insurance pool, we will actually launch it, and everybody gets that policy. And then they have the model to automatically adjust the premium pricing based on claims history real time, because they know their first guess on what that premium is wrong. 100%. It's wrong because there's no data to base it on. You can make a best swag, but it's going to be wrong. So their whole thing is, fine, it's wrong. We're going to really rapidly whip this thing up and down until we, almost like a Bayesian approach, land at an equilibrium of what this thing should actually be priced at. So something like that is fascinating for us, and I think is a huge, huge, huge opportunity in market.
Is there, I mean, what other trends are there in financial services around, I don't know, threats to, what's the term I'm using for it? Like cyber threats, how money's moved around. I know like Acorn is an example. Like what other opportunities are you seeing that could really, shake up the way that consumers spend money on things, pay for stuff, invest, banks work together? Like what else is out there that we just might not be seeing on the surface?
I think one area that you don't see much is underbanked and cash economy. It's totally zigging when everybody else is zagging. The amount of physical cash transactions is increasing by about 10% per year, which makes absolutely no sense in this theory we have the modern financial system and everything's as ones and zeros and instantaneously get money around the world. The reality is that's actually not the case. I mean, it is, in a certain subset of the world. But if you go international, especially, there's plenty of people that do cash business. So that is an area that VCs and technology need to figure out how to solve for, but it's actually incredibly difficult. It's a very regulated industry. We have one company that's making a play there, but yeah, like nobody else is looking at it, right? It's very, very, very rare to find somebody who's actually even interested in it because, well, same arguments that you can have against cryptocurrency, which is the only people who do cash are drug dealers. And the reality is that's just not the case.
Interesting. Well, Kenny, I really appreciate you carving out some time for me, man. You got a lot going on professionally, personally, with the house and everything, traveling across the country right after we hang up here. If anybody wants to find you online, learn a little bit more about Diffuse, where can they find you and learn a little bit more about your company?
Yeah, diffuse.vc is the website, or Kenny at diffuse.vc, or Westloop Ventures if you have any seed and Series A B2B financial services startups. We will gladly look at them, and that's westloopventures.com and Kenny at westloopventures.com.
Very good. Kenny, thanks so much for carving out the time, man. Always a pleasure, and I'm sure we'll run into each other soon.
All right, sounds good. Thanks, Tim.
Take care. Bye-bye.